Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My return guest today is Kathy Fettke from the Real Wealth Network. Kathy's been investing in real estate and studying markets for more than 25 years, and her message hasn't changed. Tune out the headlines, follow the fundamentals, and let time do the heavy lifting. Today, she breaks down what she's watching in 2026, why she's doing a 1031 into Oklahoma City, and why investors still waiting on rates are missing the point entirely. Let's get to it. This is episode 359 of Zen and the Art of Real Estate Investing with my return guest, Kathy Fettke. Kathy is the co-founder of Real Wealth, a best-selling author, a real estate podcaster. I'm sure you know her already, but she's an expert in turnkey real estate investing syndications, 1031 exchange replacement properties, and so much more. She was last a guest on this show, episode 117, March 4th of 2024, Simplifying Real Estate Investing to Find Real Wealth. Kathy, welcome back.
Thank you. So glad to be here. I can't believe it's been 2 years.
I know. Yeah. Boy, time is flying.
Yeah.
Well, so it has been 2 years and now we're in 2026. And I know you're all over the markets for yourself, for clients, and also talking to everybody. What have you seen in 2026 that surprised you?
Well, more inflation, I would say. Yeah, we were kind of reversing, heading down. Rates were coming down. There was potential for the Fed to cut rates. Mortgages got below 6%. It was, at 5 for a second.
Yeah.
And we started to see more affordability and housing sales. And then, then we had a war.
Much.
Yeah. Then we had a war. And then, of course, oil prices have gone up. Oops. Is that better? Okay. Yeah. Oil prices have gone up, and we need oil for everything, transportation and making things and driving, of course. So we are seeing inflation just about everywhere.
Yeah. And I mean, I guess it goes to, you've been in this a long time, so have I. Like, long-term real estate investors, they strive by being resilient. They understand that there's going to be cycles. This is just another cycle for people like us. But what do you tell those new investors who are trying to get in now and they keep looking at the rates, but they've been doing that really for 2-3 years now? Hey, they're still up and down a little. They haven't really adjusted a ton either way.
No, they've been hovering around this for a while. In fact, rates are lower than they were last year.
Yeah.
When they go down, you should really jump, because there is no guarantee that they're going to go down further. If anything, I think it's going to be the opposite. And I've been saying that for a while, that we are in the middle of a new boom. It's an AI boom. Life is going to be very different in the next year. Usually when we have any kind of breakthrough, people are afraid of job losses. I think it's going to create more jobs. There was a talk that Uber was going to wipe out taxis. There was a talk that Airbnbs were going to wipe out hotels. Those things just don't happen. All it does is create more jobs. So I think we're on the precipice of massive growth, and that means inflation. And boy, the longer you wait, the more you're going to pay for things.
Yeah, I agree. And I think that just goes to staying on course all the time. If you're interested in real estate or you have real estate, you should always be paying attention to what's going on, maybe missing the overarching news, because the news is just recycling stuff that's always going to happen. I always try to stay focused. And I know you've had a podcast for so long. I mean, your original podcast was one of really the first. You stayed on top of it, but is that one of the most important things for people to know, that you kind of have to like cut out the national spectrum because it's not telling you what you need to know in your market or your asset class, or
Yeah.
maybe what your next step is?
It doesn't apply to you. The news, the headlines are not meant for investors.
Yeah.
It's meant for the general population. When we talk about housing, it's about buyers. It's about people who are interested in buying. And if you are holding real estate, it doesn't matter. Are rents going to change? Are my rents going to change because oil prices are up? No. I mean, it's a lease, a 1-year lease.
Yeah.
It's just kind of this more of the same. So we don't have to get so caught up in the daily news. I think if you're in an industry that is more affected, for example, crypto, or if you're in the stock market, if you're a trader, if you're a flipper, you do need to be very much aware of what's going to happen in the next month or two. But if you're a buy and hold real estate investor, it's just noise. Just don't let it bother you.
Yeah, I mean, the whole point of becoming a buy and hold long-term investor is to ignore the noise, to just
Exactly.
basically let it ride and have those assets. And as you said, it's so right. Well, great, you have a lease for a year. It's probably going to release again. It's not like it's going to go from $2,000 to $800.
Yeah.
It's probably going to go up. There's still a shortage, so you just steadily keep going up. That's why long-term rental properties are so good for us, over the history of real estate.
Yeah, I mean, I know there's pockets where it's been a little bit harder to rent if your lease comes up. I think Phoenix got a little bit oversaturated. It always comes down to supply and demand. If there's too much supply coming into a market and not enough demand, you will see rents go down, or you'll just see vacancies.
Yeah.
So we try to stay out of those. What do I like to say? I like to say if I'm on an airplane in Europe and somebody says, they name the cities they know of in America, those are the cities I'm probably not investing in, right?
Yeah.
If they're going to talk about Vegas and Atlanta or New York City, San Francisco, these are cities that it takes international investment. But are they talking about Cleveland, Cincinnati, Kansas City, Oklahoma City? Even in the Dallas area, we're not investing in Dallas. We're like an hour outside of Dallas, in areas that most people don't know about and builders aren't flocking to. So you're just not going to have those supply demand swings.
Yeah, well, I mean, Texas is a great example because I think people who aren't from Texas or don't invest in Texas, they just think, "Oh, Texas, it looks big on the map." But I mean, it's gigantic. And
Yeah.
just Houston and Dallas itself are so gigantic. It's not like you could just say, if someone were to say, "Oh, I have a friend in Dallas," like there's a chance you'll know them. They don't realize how big it is. So is a state like Texas interesting to you because of that? Because there is these kind of spotlights on towns, but that actually trickles over to these sub neighborhoods that have so much opportunity to go up.
Honestly, I just follow the fundamentals that I've been talking about for 26 years on my show, on The Real Wealth Show. After interviewing Robert Kiyosaki in 2004, it just made sense. I just adopted what he told me on that, and I've just tried to stick with it. Anytime I would stray from these fundamentals, I get myself in trouble. And for some reason, I did. But if, what he focused on was invest in areas with job growth, because when there's job growth, obviously, then people are seeing wage growth. You're seeing population growth. People want to be where there's jobs. And then as there's population growth, you need infrastructure growth. So cities that are investing in themselves are building new freeways, new hospitals, new schools. This brings on more jobs. And if all of that is happening before prices have gone up, where you're still the average person can still afford the average home, then you're like positioning yourself in front of the wave. I literally went surfing this morning and I was thinking, boy, if you're not positioned properly, you will miss the wave. And I'm smaller than the guys out there. I'm the only female. I'm older than all of them. And yet I could catch a ton of waves that they couldn't because I just know this particular spot. I know where to stand. And the wave comes and I ride it. I don't have to fight too hard for it. And that's what it's like if you follow the fundamentals. You just get in front of the wave of growth and you just let it carry you. So that the reason I like Texas is simply because It is a business-friendly environment.
Yeah.
Businesses, I mean, we've been investing there for 20 years and it was business-friendly and it hasn't stopped. You keep seeing other states not understanding, again, fundamentals. These are fundamentals. Do you want businesses which create
Right.
jobs or do you not? And if you don't, appreciate businesses, they will leave and find someone who does, right?
Yeah.
So
I mean,
every single day we're seeing headlines about companies leaving Washington because of the millionaire tax, leaving California because of the billionaire tax, leaving New Jersey because of the high taxes, and they're moving to Florida and Texas, no income states where they welcome the business and they
yeah.
continue to grow.
Yeah. I mean, again, it's fundamentals, like you said. And if I go back to all the things that my dad told me, I still kind of invest the same way.
Yeah,
I still look at assets. That's the thing that I'm focused on. And then what's around the assets, like geographic things. And I still think I always tell, even for people who want to start flipping now, like what you should just drive for dollars. But I think there's so much technology out there now. Of course, we have AI, which is enhancing that. But I completely agree with what you said at the beginning. I think there's a lot of opportunity if you know how to use AI and not try to replace yourself to do even better. But also, if you still want to drive for dollars, you don't need an app or anything. You can just drive and look for the things that all of us always look for, changing neighborhoods or houses with problems, right? I mean, it's still
yeah.
out there.
Yeah, absolutely. I mean, if you don't have the massive job growth and population growth, then you do need to be able to buy real estate at a discount when you buy it,
Yeah.
because you're not in front of that wave. You're not going to ride it as prices go up and as population grows. So if you're in a more linear market, like say Jackson, Mississippi, the prices there just kind of don't go up very quickly. So you better be getting massive discounts because that's where you're going to be. That's why so many investors say buy, you get your equity on the buy. And that is for sure true in linear markets. But if you're in booming markets and growing markets, it's a lot harder to do that because you're going to be in areas that are newer. There are maybe even brand new homes that you might be buying because the whole area is new.
Yeah. Well, yeah, let's talk to some out of state investors because I do live in California. California is a place where a lot of people say, I don't want to invest here. And
Yeah.
also I can invest here. So they look to other places to invest, but then sometimes they don't have enough time to really figure it out. So let's try to give them some advice because I've I've been an out of state investor, but I try not to go too far. Obviously, with syndications, I'm fine. I'm judging those markets. But for people who want to be like quasi active out of state, where do they start? Because I know you guys have been doing that for so long.
Yeah, the biggest mistake that anyone makes in investing ever is just not understanding what you're doing. So if you come from a California mindset and you go to Texas, like when I first started investing out of state, I found a regular real estate agent.
Yeah.
She picked me up from the airport and she took me to the most expensive neighborhood. And it's like, Californians love it here.
Yeah.
And it was like $400,000 for for the home she was selling. And I knew
Yeah.
the median home price was 120. So I looked at her, I'm like, you're not my agent. You're not working for me. You're working for your commission.
Yeah.
So not understanding that local market is a huge problem that out of state investors, get confused by because it's so different. They
Yeah.
just can't even fathom. Californians couldn't fathom $120,000 house. Like that just, you
Right.
can't, maybe a car, I don't know, but not a house. So get educated would be my first thing. I mean, I wrote a book, Retire Rich with Rentals, for people who were investing out of state for the first time. Just get the information you need to do it right. But the main thing is I would say the thing that helped me the most was to get my property management in place first before the property.
Yeah.
Because you could find a great property, but if you don't know how to have it managed, you don't have a good manager, it's not going to go well for you. You're not there. No one's there taking care of it. And management will drive it into the ground if it's not good. So
Yeah.
get your best management and then ask them. You've got the property manager. What would you buy? What would you like to manage? You're going to be taking care of this. It's like
Yeah.
buying a puppy and then, having someone take care of it. They should know how to take care of that puppy. So, right?
Yeah, of course. Do you feel like in today's technological age that to be successful out of state, someone needs to go to the area or should they go to? In my head, I think
Yeah.
yes, but I know people who've been successful never going. It just worries me just from a like
Yeah.
tangibility standpoint. What do you think about that?
There is a lot of technology that you can use these days to be able to buy sight unseen. I wouldn't do it. Now, tons of our members at Real Wealth and myself included have bought properties we
Yeah.
haven't seen, but we have already visited the area.
Right.
So there's just something about real estate. It's tangible.
I
And for
agree.
me personally, I get a feeling when I'm standing on the land, I just either like it or I don't like it. And if I don't like it, my tenant's not going to like it. So I personally will go out. You're talking about a pretty massive investment and a $400 flight, and a
Right.
day. You could go out there and back. Like, why not? Why would you not do that?
Yeah.
If you don't have the time, then go through a company like mine, go through a company that's going to help you be able to buy remotely because the teams have been vetted, the areas have been vetted, and you have a whole network behind you to support you. But just kind of going out there on your own and just buying some random property. I've seen people screw that up many
Oh, yeah.
times.
Yeah.
Buying in the middle of nowhere, there's no jobs nearby, or it looks good. I remember being on a property tour with like 20 investors, and we're just driving through parts of Cleveland, and somebody called and said, "Hey, I'm looking at buying this multifamily. It's right near a university. Are you near it? Can you drive by it while on your tour?" It's like, sure, we're close.
Yeah, we're here.
It was not anywhere near a university. I mean, it was like a mile away, but the mile away was a mile, like miles away. It was,
Yeah.
you had to go under a bridge, and when you went under that bridge, you were in a different world. And I was afraid to get out of my car. When we did, we had people saying, get the, what out of our neighborhood.
Yeah.
We also saw the sign, and I called and, pretended like I wanted to rent because this person had been told that it was fully, that it was full. And I called. I'm like, "Hey, I'm here with 20 of my friends and we're looking for rooms." They're like, "Oh yeah, we've got one for each one of you." Like, okay, this is definitely, they're lying.
Yeah.
So just, you can't trust people. You just can't trust people. There's scammers everywhere.
Yeah, I think that's great advice. That's what I was thinking. I was like, if you do all of this research and you spend the time and you really focus in on a market, you talk to some experts, and then you decide, like, this is going to be my market. Like, I want to really get into this market. And financially, like, you can do a fair amount of business there. Fly there first,
Yeah.
look around everywhere that's in the zip codes that you like. And then when you fly back, at least you have a frame of reference when you're going, and you have point of reference with the people as well. You can meet them in person, get that eye to eye contact so that it feels better when you go back. Same as you. I feel worried for the people who they're busy and they want to just do a one off in Cleveland. Like you said, oh, well, this realtor I met in a Facebook group said they have a good two family, and it's,
Yeah.
1.7% rule. I'm like, well, does it need repairs? They said no.
Yeah. Uh-huh.
Yeah.
You're telling the story that I heard, a very heartbreaking one, from an Australian who listened to my show and didn't end up buying through our network
Yeah.
didn't buy through Real Wealth. She just bought, same thing, like you said, a duplex. Same thing in Cleveland. You've got the Cleveland Clinic and the best healthcare in the world and all the nurses and doctors who need housing, but not very far away from that is a pretty rough neighborhood. So here she looks on the map and she's like, "Oh gosh, this is real close to the Cleveland Clinic. I'm going to get all these patients to stay here and these doctors and nurses." No, she couldn't get anyone to stay there. In fact, the property was in such disrepair. It was almost a tear down. She had to put, oh gosh, I want to say like $1 million into it. Big mess.
Yeah.
So, you do really need to understand your market or have someone there, boots on the ground, who can help you, and always get an inspection, always get a third party inspection. So you really know the quality of the property. And usually that inspector will tell you the quality of the neighborhood too.
Yeah. Yeah. I learned very quickly in Philadelphia, like, wow, this just from block to block, things can change so much.
Yeah.
And during the pandemic, we were all bored and we had a group, and they ended up doing about 42 deals in Philadelphia when we were doing online meetups. But it was because we were all working together to figure out where the blocks were breaking, talking to locals. We actually had a Philly SWAT cop in our group. So he would say, like, nope. He just said, no, like that, you can't do it. And he was right every time, because that's, that type of city investing, it looks attractive because you can get something, for 62 grand, but that doesn't mean it's not going to come with a bunch of capex and problems and rough tenancies.
Yeah. Yeah, absolutely. Oh, same with Kansas City. There's a really nice part of the city, the plaza, and not very far from that is a very rough area, but the houses are adorable.
Yeah.
So if you didn't know, and I know a lot of investors who didn't know, they're like, look at this cute house I'm buying. It's like, good luck trying to rent that.
Yeah.
No property manager will touch it. They don't even want to go to the neighborhood to collect rent.
Yeah, I feel the same about Detroit. I see a lot of stuff,
Oh,
and there's a
yes.
lot of up and coming parts. But like again, if you don't know where that is, you could be 2 blocks over. It could be a whole different story. I mean, this is something you said really stood out to me because I started thinking about how people think about realtors. And your first story, um, you know, s- for the Australian who contact you guys bought outside of the network. I think it's very similar to getting assistance with turnkey and understanding how to do that. To me, is similar to making sure that you're picking an investor friendly realtor, like your first
Yes.
example, because you just think all of a sudden, I think people think, well, I don't really need their help. I can just go get a 2 family.
Yeah.
Or I don't really need someone who's experienced. They work Cleveland, so they understand, what a duplex is going to do. And it's just not the case. And I don't
Yeah.
think the national news helps because, they make everything sound like, oh, all realtors are bad and they're not special. But the people who know investment is a very, very small percentage, especially for people who are wanting to learn. Do you see
Yeah.
those two as a corollary? And buying outside of a turnkey network can just be disastrous because it's not turnkey then. If you
No,
have
it's
to
not
handle
turnkey,
it.
and you're usually working with the agent who doesn't own rental properties
Right,
and
right.
never take their advice on what they think it's going to rent for. They don't know that the first thing you need in place before looking at property is that property manager.
Yeah.
When I went to Dallas 25 years ago, when Kiyosaki told me that's where he was investing, I was like, I better go learn Dallas. And I met with 10 property managers. I stayed for a week and I met with a different one every day,
Yeah.
sometimes several a day, for them to tell me where's the rental demand, where would you invest, where are your investors getting the best results. They are not making a commission on the sale. If they are making a commission on the sale, you need to be a little more wary. But
Yeah.
if their only job is to manage your property, they are going to tell you the truth because they don't want to manage a dog. They
Sure.
don't want to deal with a problem property. It just makes life harder for them. They're the caretaker for as long as you own it. So yeah,
Yeah.
that's going to be your most trusted advisor.
Yeah. It makes a lot of sense. I think some people could think, oh, well, maybe they pick a lower value neighborhood so they can get more doors to manage. Like, no,
No,
that's more headaches. That's like more
no.
calls. The last thing they want is more calls. They want it as easy as it can go. I mean, I don't blame them.
Yeah.
It's a tough job.
Cheap properties are expensive properties.
Yeah.
Yeah.
Hey, it's Jonathan. If you're interested in what Kathy's talking about and you want to join the 88,000 members of Real Wealth, it's pretty simple. Go to realwealth.com. There you'll see how you can join free and invest smarter. Investors building wealth in real estate. And like I said, there's more than 88,000 in the group. See you there. Let's get back to the rest of the show. If you look at the new investor, do you think they act differently than we did? Like when you started investing, when I started investing, again, like I said, I still kind of act the same, but I still see some people who are old school, but I do see some people who think that it's going to be easier, as we were saying. And I guess I feel worried for them. I think some people work out, but now they're doing it even large scale. Syndications are 1031. Sometimes someone will take a 1031 and they think, well, I have to roll this money over. So let me just roll it into something that somebody shows me. It has become much easier than it used to be because you can see so much online that appears to be great,
Oh,
but
yeah.
it's scary.
Oh, yeah. No, I'm old enough to say that, I lived at a time when the only way you could find out about what's for sale was through an agent. That was
Yeah.
it.
The
That was
book with
why
one like black and white picture that you couldn't even tell what the
you
front looked like. Yeah.
and you couldn't get into the house.
Oh no. Yeah.
The only way to find out what was available was through an agent. And how could
Yeah.
you possibly invest out of state? I mean, it would be so hard.
Yeah.
Today, and we sometimes have information overload, but I'll tell you what, I wouldn't trade anything. I would want to know today you can find the property on your own and look at stuff, but you still don't really know what you're doing. But there are
Yeah.
so many resources out there for you and more coming with AI breakthroughs. Oh my gosh. Boy, nobody was helping me with underwriting. Now I've got
Yeah.
so many AI assistants helping me.
Yeah.
You've got it good now. there are there's a lot of opportunity, especially in multifamily right now.
Yeah, and that's where I think AI can really help is if you take what you're seeing, and working on an actual reps, and then you load it in there to, have AI kind of help you go through and identify things that you may have missed. It's really good at that, but it takes like prompting and understanding. If you don't understand real estate investing, you won't prompt the AI right, and it will
Hmm.
deliver you, probably some oddities, I would think.
Oh yeah. Oh yeah. Yeah. Got to have the right input to get the right output.
Yeah. Are you seeing any asset classes? I mean, obviously, everybody always talks about multifamily, but what other asset classes have you seen that you think are going to become more interesting in the next couple of years?
Well, for sure, multifamily is like going back often people say today feels like 2008, and it's nowhere. It couldn't be more opposite in the single family or 1 to 4 unit world.
Yeah.
And I could talk about that for days if you want. But multifamily is acting and behaving. Commercial real estate in general is acting and behaving more like residential real estate did in 2008,
Mm,
because back then everything was on adjustable rates, and today
yeah.
it's the same problem with commercial real estate, adjustable rates where rates have doubled, if not tripled, and it very much affects the valuation of commercial real estate. Anytime basically commercial real estate is the value is based on net income. So
Yeah.
if expenses go up and income goes down, your value goes down. So that's what we're seeing. We're seeing, because of rates going up and other inflationary things like in insurance and just the cost of maintenance and so forth, just massive expenses while income is down. So we're seeing multifamily deals 30-40% discounted,
Yeah.
which isn't really a discount. It's really just what it should be worth. It's just what it's worth.
Right. It was
You know,
over. I mean, yeah, not necessarily overvalued, but the levers were up, and now it's not working out.
yeah, just for with today's interest rates and costs, you have to get the property at a certain price just to make the numbers work. And that
Yeah.
happens to be a much lower price than so that's a great opportunity. But in addition to that, I think if I were starting today, and I don't think I have the energy to do this, but I told my son-in-law who's in the other room, he should
Yeah.
look into this, is assisted living. Because,
Yeah.
this has been
Absolutely.
talked about for a couple of decades, the silver tsunami, but,
Yep.
it just hasn't hit. It hasn't hit because us oldies, are staying young longer.
Right. Right. We're healthier,
We're
fortunately.
biohacking, we're taking our
Yeah.
vitamins, we're
Yeah.
exercising, we're not smoking. I mean, I think
Right.
smoking was kind of considered healthy back in the like
Yeah.
40s, 50s. Everyone was
Right.
doing it. So we're living longer, and that tsunami has been extended, but it is starting to hit. And baby boomers are between the age of like 61 and 81. So the older baby boomers are needing care, but assisted living could be for anyone. It could be for a younger person too, a
Yeah.
teenager if they need help.
Yeah.
And so one of, I think, the best opportunities is senior housing, assisted living. I don't know that I have time to learn a new asset class, but if I were, that would be it. I'm just going to stick with what I know for now.
Yeah, I really agree with that. It's like very interesting to me, but same. I'm like, look at it like, do I really, it's like, I don't know that I have the energy to get into it
Yeah.
now. Like maybe I would hop into something passive because I really do think like that's coming because as much
Yeah.
biohacking as we all do, I mean, we can't all pretend to be Brian Johnson. We're not going to 160. So it's
Yeah.
like, you want to balance it. But yeah, I think that's just a great recommendation because if you're new to it now and you have the energy, you can really go full in and learn it. And I do think there's a lot of people who are starting to get into that space, and you're seeing it become more active.
Oh, it's insane. I mean, the amount you can rent per room is astronomical, and a lot of that's covered by insurance. So again, if you want to really, really increase your cash flow, that would be a way. Another way is just renting by the room in general.
Yeah,
That is seeing more people doing that. Midterm rentals. I just came back from a conference on midterm rentals and, working with corporations who
yeah,
maybe are putting their people, they have to be in a certain area for a certain amount of time and they need housing. If they're staying at a hotel, they're paying that you could save them money with your midterm housing
yeah.
and you could make a lot more money. So many, many ways to make money these days and to increase cash flow and opportunity is out there.
Yeah, don't you think it's so great for people who are getting into it now because you can buy a single family or a multifamily and now you can have three different options. You have long-term rent, mid-term rent, short-term rent, which could honestly work in most markets if you're balancing what's out there. I feel like that gives you just a lot more opportunity, especially for
Mm-hmm.
people who buy a four family. Like my favorite thing would be to have a three family with one long-term, one mid-term, one short-term. What a
Yeah.
diversified asset just in itself. And then you could always switch it out, take the furniture, put it somewhere else, bring in a long-term renter. I think my dad did stuff like that. Like he did weird rentals, college rentals. He definitely did some like rent by the room and properties. So I think people had done it, but now it's kind of out there and now there's a lot of content on it. Even midterm rentals has sprung up so much in the last, 4
Oh, yeah.
years. But that's it. Midterm rentals is just a great option because it also gives you that great pivot when short-term rental regulations come in if they're going to
Yes.
knock you out. So
Yeah.
I really like it.
I'd be cautious in places that are not landlord friendly, like California, because you
Yep.
better have your leases in place.
Yeah.
But I had a property in a ski town, and so there's seasons, and during the down seasons, they would just sit empty for months.
Yeah.
And then my daughter told me, Mom, you can significantly discount the rate if they book for a month, which I knew, but I just never thought about it. But she said, as a traveler, she's always looking for places that will give a 40 or 50% discount if you stay for the month.
Yeah.
And that's still higher than if you were to rent it for the month. So I just changed that little button and it's constantly rented. It's always rented now.
Yeah.
So yeah.
It's a great way to cover the loss that used to. I learned it early because I had my sister and I had a couple short-term rentals in the Hamptons when she moved, and that's obviously huge summer market. So after we were gone, we were renting the summer, made plenty of money, so you didn't have to worry about it in the winter. But then we stopped going, for Thanksgiving and stuff because she went to California, and then we were like, well, we started to get renters who were like want to come out for 6 months, and then they wanted 3 months, and
Yeah.
we figured out. So we were really doing that kind of midterm 20 years ago, but it makes a lot of sense. I mean, it's
Oh,
just a
yeah.
way to keep your property going. It seems like free money a lot of the time. I mean, of
Oh,
course, you have the
totally.
maintenance, but especially when you don't realize it and it's just sitting there because a
You
lot of
don't want
people.
an empty house. It's
Oh, yeah,
it's not good for anybody.
yeah,
No.
exactly.
Get it
Right.
rented, keep your standards high, but get it rented.
Yeah, and midterm renters traditionally are great renters because they're really coming to it feeling as a home. A lot of them are
Oh,
just
yeah.
going for midterm rentals, midterm rental, either doing contract jobs, nursing, whatever it is. They're always going around. So they really treat it like a home. And what I like about midterm rentals is, as an operator, is you don't have to get like a pickleball court.
Yeah,
That's
right.
not what that avatar is looking for. They just want
Yeah.
like nice blankets and
Just want
stuff
a
and
nice, comfortable
good
place
internet.
and maybe a kitchen.
Yeah, right. And like they understand what it's for and you don't have to use the same channels that you do for short term.
Yeah,
Yeah.
absolutely.
What else have you seen this year that you think might trend, I guess, let's say down in terms of what people are looking to do? You and I both were out there talking to a lot of people. We hear what they're trying to invest in. Is there anything you're worried about people investing in 2026, as something that's been hot, but maybe it became more like a social media trend?
I don't know much about it, but boutique hotels kind of became a trendy thing for Gen Z, I think. And
Yeah.
I can't say whether it's good or bad. It just seems like anytime there's influencers getting everybody into their courses to teach something, that eventually you've got a lot of inexperienced people buying things and probably overbidding for it.
Yeah.
So I think just in general, I would just leave it at that. Like, don't take a course from an influencer and then think you're a pro and go out there and do something. That's how so many syndicators got themselves in trouble over the
Yeah,
last couple of
exactly.
years,
Hmm.
thinking that I had so many people come up to me at events saying, hey, can you give me advice on becoming a syndicator? And I'm like, well, what's your experience? None. No, you're
Yeah.
absolutely not. Your first deal, if you need to use other people's money, you use mom and dad, the bank of mom and dad. You got
Yeah.
to do some deals on your own or, hard money or whatever before you're using investor money and get some experience. Not some, a lot. You should have 10 deals under your belt before you start bringing in investors and syndicating, and then do that same type of deal that you had success in. Not, hey, I have 10 single family rentals. Now I'm going to buy a 100-unit apartment and
Yeah.
syndicating with other people's money. Danger.
Yeah, I think that's like the short-term effect because I've always said that even the worst gurus out there, most of the time the course information is actually fine. It's not like
Yeah.
the course is all fake. They took it from someone else. If you do what's in the course, you'll probably do fine, but it's not
Yeah.
about that. It's about the upsell and the side sell. And if
Hmm.
you as a user or a participant in the course are going to get with the other people and work together, or you're just going to read the thing. They say, go get a property, and you just go get a property and hope that it just does it itself, which of course we know it doesn't.
Yeah. Yeah, for sure.
Yeah. That's what I'm worried about though. So in terms of, let's talk about building real wealth. How do you think the best way to set the foundation is now, 2026? Interest rates are high, so people are a little bit more scared to get in, but we both know there's still a way to build a foundation. Real estate's a great part to build on, but I see a lot of people who I think are doing what they always say, I'll just wait for rates to come down. And what we've seen over the last 3 years is you could have done a lot of great deals over the last 3 years and been much farther along if you just weren't trying to crystal ball it.
Yeah. I'm going to take a quick sip.
Yeah.
Mm-mm-mm. There we go. It's the rate doesn't matter. The price doesn't matter. None of that matters. What matters is the numbers.
Yeah, I think a lot of people, maybe they don't want to crunch the numbers enough or don't know how. So they back into the rate, or they're scared. So they use
Yeah.
the rates, or they hear other people say, hey, let's just wait for it to come down. And then my first question is always the same. What crystal ball do you have that I don't have? How do we know
Yeah.
when that's going to happen?
Yeah, that's what's so great about residential is you can lock in your rate.
Yeah.
So you can pretty much know what your numbers are going to be. So if you found a property that was discounted by $100,000 from what someone paid for it a couple of years ago, and you had to pay a few hundred dollars or a dozen, I don't know, $12 more per month because of the rate.
Yeah.
Like it doesn't
That's the
matter.
craziest thing. Yeah.
The rate doesn't matter. What matters is in the end is the numbers. Did you get a good deal on the property? Is it situated in a way that it's going to grow over time? It's desirable. I think that's the key word. Did you buy a desirable property, or did you buy something that nobody wants?
Right.
Or that you're not going to want because it's in a high crime area or it's out in the middle of nowhere and no one's going to live there. But if you buy a quality property near jobs in a growing market, there's going to be demand. So all you really have to look at is, do the expenses cover the income? And is there more income left over that I can cash flow, that I put in my pocket? That's
Yeah.
it. And even in some cases, even if it doesn't cash flow that much, but you know that you got a good deal on it, or you're in the path of progress. And over time, we have to remember that buy and hold is buy and hold.
Yeah.
That means you're looking at a property that you're going to hold for 5, 10, 15, maybe 20 years. How is that property going to hold up?
Yeah.
Is it going to be something that breaks down all the time? Is the area gentrifying, or is it moving in the other direction? What is this area? What is this property? What are the jobs? What's everything going to look like 5, 10, 15 years in the future? And you can get a pretty good idea because cities they plan in advance. They're not thinking about yesterday. They're thinking about where's the growth going, and just follow what their plans are.
Yeah.
If they're going to bring in a new freeway in an area, they're planning growth. They're planning growth. So, yeah.
I think Americans, if you've grown up in America, you just forget how much of a bonus the 30-year fixed rate is. Because I've talked to so many, I'm sure you have too, international investors who lived out of the country and then started to invest in America. And they're like, you don't understand. We can't get loans like this because when you have a 30-year fix, you have your projections are very solid, which is part of the problem that we talked about before with adjustable rates. Your projections can only go as far as the arm is going. You don't know what's going to happen after that. But with the 30-year, you can project. And generally in America, if you buy and actually hold, you're going to be up a lot of money.
Especially with inflation. We live in an inflationary time. Real estate is one of the greatest hedges against inflation. If you just want to make money doing nothing, just buy real estate and let inflation make you wealthy,
Yeah, absolutely. And I think sometimes people think we're talking about which properties to buy and where. Sometimes they think, oh, well, I want to buy something with less competition. And I say, but if you win, multi-bids are obviously popular. If you beat 10 people, what do you think's going to happen in 10 more years? They're not, in an area that's dense. They're not building more. Now you
Yeah.
might have 20 bids in 5 years if you want to turn and sell it. You want to be in the path of progress where people want to go. Of course, you don't want to overpay, but I still don't see it as overpay. I've had a lot of people who beat 14, 15 people, and now we're up 250 grand just 3 years later because they
Oh,
like
yeah.
the asset.
I'm going to tell you my dirty secret. I do not mind overpaying. I really don't.
Me neither. I love
don't
it. Yeah.
mind. I'm not one of those people that needs to nickel and dime. I don't
Same.
care. I'm not thinking about selling it tomorrow.
Yeah.
I am thinking about what this is going to be worth later. I have paid full price. I literally just closed on something today that I offered 20,000 over asking,
Yeah.
but I know the area. I know what's coming. I could care less in 10 years. It would just be, I think this property is going to go up hundreds of thousands of dollars. Why do I care about, 20,000? I don't.
Yeah.
I don't. It's going to go up so much. And I'm so happy that I was able to get it because there was competition. There were 3 or 4 backup offers.
Yeah, you need to have a good agent to be able to do that. But I feel exactly the same way. I'm so glad you said, like, when I bought my house here, I think I offered 50K over list price at the time, and they thought they were going to get multiples, and then they didn't. And I said, listen, this is a good house. You'll get them. They'll trickle in. So I'm not going to move my offer down. Like, that's my offer. And they just, right when they were going to maybe have best and final, they just took the offer. They would probably get more and could have balanced it against, but I was the only one who's just like, no, it's definitely worth that. And now I'm up, 300 grand just for being smart, but I think that a lot of people do get into that. And we brought it up a little before, that like last thing, especially with the rate, like they're like, oh, rates went up a quarter point. It's like, do you know how much a month that's going to cost you? It's almost nothing.
It's like nothing. And especially on a rental property. I mean, most of the rental properties that we promote at Real Wealth or that we refer people to, I mean, they're still in the 200,000 to 300,000 range. So we're talking dollars, it's like $10 more a month. It doesn't matter.
Yeah.
What matters is the numbers, and the numbers are pretty easy to figure out.
Yeah. Don't you think a lot of people, they get into this like stand on principle or stand on ego, and then, the people like us who are just like, I'll pay the extra. 3 years later, we're up a bunch of extra money and I also personally don't, my dad was a haggler. I'm not, because he always embarrassed me by doing it everywhere. Like, I love that he did it and he always got the deal because he was super nice. I just don't, it's uncomfortable for me.
I don't like it. Yeah. You know what? I don't get an adrenaline rush from it. I know some people love it. I feel bad.
Yeah.
And I don't know. So I don't care. It doesn't matter to me. What matters is, did I buy a quality property that's going to be worth far more? Example, when I left that agent in Dallas, and I found a property manager, and that property manager helped me buy brand new homes in Texas. This is 23 years ago.
Yeah.
And Dallas was not what it is today. It was sort of a nothing burger. There was no appreciation for decades. And, but I knew what was happening. I knew the growth that was planned. And I ended up buying houses for $120,000 to $140,000 that were brand new. Yeah. And maybe at best I was getting a few $1,000 discount, but I was mostly paying retail for brand new houses, but they cash flowed. And I knew that they were in A-class schools and new freeways and school hospitals coming in and businesses moving there. And they were beautiful. And I knew my tenants would love them. So it just made sense. Well, I can't even tell you how many much more experienced investors just look down their nose at me like, oh, honey, you get your money at the buy. You should have bought, this home. It's like, that's an old rickety house. I don't want an old house. I'm in California. This is in Texas. I want a new house I don't have to worry about or think about. It's in a nice neighborhood, A class. You want me to buy in C class? No. Yeah. And sure enough, those properties have tripled in value. They stayed rented. I'm a fancy investor. I'm a white glove investor. I just like the nice stuff.
But that goes to the tangibility, though, because you put your eyes on it and saw it, and you're like, I like this. Other people are going to like this. I don't know. Maybe I find I love spreadsheets, but I actually don't use them as an investor very much. Because I feel like I need to see it. I want the tangibility. I like to look at the property no matter what it is, even if it's a syndication. I want to get a good idea of what the feel is. And like you said, you can get a lot of feel for the neighborhood too. That's why out of state without going there can be so deceiving because you just might
Yes.
not know which way the path of progress is going. Because like how people search, I'm an agent, of course. They send me a home. They'd like the home. They've never even heard of the town. I go, do you know where that is? Have you
Yeah.
looked on Google Maps? Like
Do
what?
you know what you're asking here?
Yeah, it is because anything can be made pretty these days, and you really have
Yeah.
to get back to the old thing and figure out where everything is.
Yes.
Yeah. Well, let's leave them with a little bit more advice. If someone wants to get started, build a portfolio, say they already have, a decent portfolio going, but they want to grow it now. Should they just keep nose to the grindstone or look to anything new? I mean, we've really given them all the advice that they need, but what can you send them off with one more good tip uh, from all your years in the game?
Yeah. One more tip. I'm trying to think of some like breaking news story.
Yeah,
What's interesting is that Office is coming back, and Office hit bottom hard. I
absolute rock bottom.
wish
Yeah.
I understood it better. I would have bought them, but I didn't.
I didn't know
But
what to
you could,
do with them,
I,
right? Like
yeah,
I couldn't see because you can't convert to residential most
yeah.
offices at a cost that makes any sense. So I was the same. I'm very interested, but like, I don't know what to do with it.
Yeah, and it's, they're big, but I mean,
Yeah.
the people who did buy them, probably mostly Wall Street firms, got them at huge discounts.
Yeah. Giant.
And anytime you go through an unusual circumstance was a pandemic and people working from home. For a while, people not working at all. The
Yeah.
entire world just shut down. This is quite unusual. And then people started to act like it was usual, like it's normal that
Right.
these offices are going to stay vacant forever. Everyone's going to work from home forever. No, it was a pocket.
Yeah.
It was a time when that happened. And now we're starting to see offices fill up and leasing is increasing. So I would pay attention to that. It just comes back to the fundamentals of where the jobs are going. But jobs are going back. People are going back to work. San Francisco, not a place I would invest, but it is absolutely booming.
Yeah.
Office space has been leased out and values going up. New York City, Austin. Austin's the one that I would probably pay a little bit more attention to because now as the downtown office space is leasing out, guess what that means? They need people and Austin's on sale. So again, don't get caught up on the headlines that say, there's too much inventory in Austin. There's too much in Florida, too much in Dallas. This is all your opportunity to get into hot markets that are currently not hot, but still growing. They just overbuild. They just overbuild because they're so hot, but they're coming back. But you have a moment to be on the buyer's side, have the buyer's power. Those areas don't normally, the seller's usually in control.
Yeah.
But for this moment, the buyer gets to be in control. When there's too much inventory, you get to negotiate. I'm not a haggler either, but I do, if I can get a better deal, I'll get a better deal.
Yeah.
If there's a bunch of inventory, it's sitting there for a long time. I'm just going to throw out a number, see if they'll take it. And they might because, some people when they're in distress, they need to move. They have to sell. And if you can do that in an area that's coming back to normal, a lot of these pandemic era boom towns busted and now are booming again. You get this window's a short window to get in there and buy while it's cheap.
Yeah, I agree. I really believe in office just because I think there's definitely a loneliness epidemic. Like people don't behave like they used to. And when I think about my favorite job, it was my first job as a prosecutor after I got out of law school because I was with all my friends all day. You go to lunch together, and then you go home to your family. But it's like that camaraderie is lost when you're all working from home. It's just not the same on Zoom. I mean, I'm an introvert, so I don't mind Zoom personally.
Yeah.
But even me, I opened a brokerage and I go to my brokerage every day and it's better for me mentally. So I see that like office has great use. And I agree. I think it's going to come back and the prices look real good. So
oh yeah. There's so much opportunity. There always is. You just have to know where to look.
Yeah. All right, Kathy, where are the best places for people to find you? I know they can go to kathyfettke.com, but also realwealth.com?
Yeah, realwealth.com. And if they go to realwealth.com/markets, they can get a free PDF on the markets that we're investing in today and that our members, we have over 88,000 members at Real Wealth. It's free to join.
Yeah.
You can find out where people are investing. We have our finger on the pulse because we have such a large network. We know what's working, what people are happy with, where they're investing and what and why. So you can get that PDF at realwealth.com/markets. Like I said, it's free to join Real Wealth and we do free webinars every week. And then of course I have the Real Wealth Show podcast and I'm on Bigger Pockets on the Market.
Yeah. What before we hop off though, what's your favorite market in that bin that are up there now? Because I know there's a lot of good ones. What's the one that you really like now?
I'm about to do a 1031 and I will be choosing Oklahoma City and Kansas City.
I love Oklahoma City.
Oh yeah. No, it's
prices are great.
Our little secret that I'm now telling you, so it's not a secret, but the governor of Oklahoma is really trying to compete with Texas and working towards eliminating the state tax. It's just like Florida. And when that happens, Oklahoma's going to just boom. It's already booming.
Yeah.
So.
But that's what's so cool about places like that. It is booming, but there's still opportunity to get in, and that's not going to close up soon. So I always look at that market. That's a great one. All right, Kathy, I really appreciate it. It's great to see you as always. Thanks so much for coming on.
Thanks so much for having me.
All right. That was Kathy Fettke, the co-founder of Real Wealth. Again, you can go to realwealth.com/markets, and then you can see Oklahoma City and all the other ones. I'm Jonathan Greene. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. And for episode 360, it's Ryan Barone. He's the CEO and former CTO of Rent Ready. Now, that is a platform that was designed originally to help Ryan figure out how to get his paperwork in order for a rental and turned into one of the biggest landlord assists in the game. We'll see you next episode with Ryan.